required rate of return. Error correct. Johnny, you want to try again? What is missing? So your 1 year treasury bill rate is 10%, right? 6 year treasury bond rate is 12.5. So we can do this two ways. The short way and the long way. I'll do this the long way so that we're doing it from basics, but you can do it a little, you can remove one more step, right? So what do you mean by the risk? The required rate of return? We said the required rate of return is your risk-free rate plus risk premium. Risk premium for default risk, for credit risk, for term risk, illiquidity, indenture provisions, right? So the risk-free rate is the short-term risk-free rate, which is 10%. Then I want an additional premium because this is not a 1 year bond, this is 6 year. And I can calculate the term premium. And the term premium here you can see is 2.5%. Okay. So additional return of 2.5% for time. And then it says quarterly coupon rate, that's irrelevant for us. We are looking at the return that we want. Default risk premium of 1.5. So for credit quality, I want an additional 1.5. Plus, for illiquidity, I want an additional 0.5. And then part 1 also says, assume that the debenture is subordinated, right? If the debenture is subordinated, if you remember what subordinated means that the debenture holders get paid, subordinated debenture holders get paid after all other debenture holders get paid, right? So when we look at what is there in the paragraph has been given to us. These are the common points of the debenture, right? This is the risk-free rate. Then you have for term risk, then you have for credit risk, and you have for illiquidity. So these are the common points. This will give me what the premium I want for a debenture that is unsecured. But now this debenture is not unsecured, it is subordinated. It is subordinated, and therefore I want an additional 1.5% return because it is subordinated, which gives me the required rate of return to be 16%. So how do you skip one small step here? It's also correct to calculate the required rate of return using straight away. Instead of using 10, we use 12.5 straight away, right? So without calculating the risk-free rate and the term premium, I can straight away take the 6-year bond rate, and to that I can add the credit premium, the illiquidity premium, and the subordination indenture provision. I will still get the same answer, 16%. Okay. So now I know my required rate of return. It is 16%. Based on the fact that my required rate of return is 16%, calculate the maximum price I should pay to buy this bond. Remember the equation? Okay. Calculate the price. Okay, what is the maximum price? Okay, Janvi. Looks okay. Let's wait for a couple more answers to double check, but looks okay. Others, maximum price? Guys, you all are so way behind in your like with the other class. Now next week the two classes will be combined. Right? What is so difficult in this sum? This is such a basic sum. What is the answer? Okay, we'll proceed with the sum. From next week onwards, I am not going to take this class. So C is your coupon for the period, right? So how much is your coupon rate? 12%. 12% into 100 divided by cost of coupons 4. So your coupon is 3. Then what is your R? R is 16%. That is for the period divided by 4, 4%. And N, how much is N? N is it's a 6-year bond, 4 payments, so 24. Right. So price is equals to 3 divided by 0.04, 1 minus 1 plus R to the power minus 24 plus 100 divided by 1.04 to the power 24. And apparently the answer that one person gave me, there is no verification. So if it's wrong, you all can figure it out when you all actually do it for the exam, 84.75. Obviously, it's not useful to stay for you all to do the questions, right? I'll let that one person give me an answer. What is the next part? What is your required rate of return?
Madam,
Yes.
I think we all got confused because of this partly payment. I was also stuck with it. So, sorry for our part.
Correct.
Ma'am, small clarification
Yeah.
that he is, since this is not subordinate, it means that we have to remove 1 point.
Yeah. So it's not subordinated. So you don't consider the risk premium that is there for subordination. So what you're saying is this is the common part of the question. This is the common part of the question. This part of the question is not relevant for the second part. So ignore this. Ignore this part when you're doing this question. It is a secured debenture.
Ma'am, that adjustment of 0.8 means I didn't get that.
So if it's secured, then there is a, so you have to look at if it's secured, what happens here? That's the question. So, so just like what we did earlier, here you can see in your required rate of return, you had this 10%, which is the short-term bond rate. Then you had the additional premium for default risk. Then you had the additional premium for credit risk. You had the additional premium for illiquidity. This is no longer required because it is not a subordinated debenture, right? It is a secured debenture, not a subordinated debenture. So this 1.5 is no longer required. So we start, this is the base that we start with, 10 plus 2.5 plus 1.5 plus 0.1. Start with that. This is, like I told you before, this is for an unsecured debenture, right? An unsecured debenture. So from an unsecured debenture, if you're looking at a secured debenture, how should this 0.8, what should happen? Now, what's the next step? This is the required rate of return for an unsecured debenture. If it's secured, is it more safe or less safe than an unsecured debenture?
More safe.
Yeah, it's safer, right? So because it is safer, I don't need a return of, if you look at for an unsecured debenture, I want a return of, how much is this? 12.5, 14.5, right? This is my required rate of return for an unsecured debenture. But do you need, think about it practically for yourself, do you need a return of 14.5% if you're investing in a secured debenture? Do you want something higher or are you happy with something lower? Are you okay with something lower? If it is secured, do you add
Yes.
0.8?
Yeah.
You remove 0.8, exactly. So you're happy with a lower return, correct? And you don't need something as high. So what do? We remove the fact that we say we give a compensation or adjustment, a positive adjustment to the fact that this debenture is now a secured debenture. So I don't need 14.5%. I am happy with 13.7%. So that's the required rate of return when it is a secured debenture. So always remember, in your indenture provisions, we spoke about several different indenture provisions. Like, for example, we spoke about, now we said any debenture in its basic format is unsecured. When a credit rating agency does a company credit rating, they are rating it their unsecured capacity to borrow on an unsecured basis, right? So when you see a company rating, this is the ability for the company to pay back to its unsecured creditors. And then if you are secured, obviously that means the property or something has been assigned to you. So because of that, you're not as high of a risk as an unsecured debenture holder. Therefore, you are willing to accept a lower return. So things that will reduce your required rate of return, meaning you will be okay to accept a lower return if the debenture, for example, is secured. If the debenture, for example, is guaranteed, right? Because this reduces the riskiness of the debenture. Things that keep the return the same, unsecured and unsubordinated, remember we said rank the same. Unsecured and unsubordinated, rank the same. However, if you are subordinated, this increases the return profile of the debenture. And therefore, you want a higher return. What about if the bond is, so I will say this is minus, this is 0, and this increases the risk, right? This is the risk. This reduces the risk, this increases the risk. What about if the bond is callable? Where does it fall? Callable bonds, where does it fall? Reduced risk or higher risk or same risk as unsecured? It is higher risk. Remember, we talked about call risk being three different things. Call risk, you don't know when you're going to get the payments. There is very high reinvestment risk when you do get the payments. And there is limited upside potential. So it is higher risk. So callable bonds carry higher risk than unsecured debenture. What about puttable bonds?
Lower risk.
It is lower. Yeah. Puttable bonds are lower risk because puttable bonds, the option is with the debenture holder. The creditor has the option. So therefore, it is lower risk. What about convertible bonds? Convertible, not contingent convertible. So convertible bonds are actually lower risk because the option is with the debenture holder to convert. But you're talking about contingent convertibles, COCOs. They are higher risk because the option is not with the debenture holder. The option is with the monetary authority to convert, right? Or a trigger event to convert. So like this, when you get an indenture, these are all different indenture provisions. When you get an indenture provision, you have to analyze whether it is higher risk or lower risk than a plain vanilla unsecured debenture. And if it is higher risk, you add a risk premium. If it is lower risk, you deduct or are happy to take on a lower risk premium. Okay. So, any questions here? Okay, based on this, calculate what is your new price. Okay. So I see we are getting a couple of answers to say 93.12. Seems to be in the right direction. Okay. So now what is the only thing that changes? Coupon remains the same, right? Because the company still pays you a coupon of per percent. So the coupon remains the same at 3. It doesn't change. N remains the same at 24. It's still a 6-year bond. That doesn't change. R changes. Excuse me, sorry. R changes. So R is 13.7% for the year. So quarterly, you got to divide that by 4, which comes to per quarter 3.425. Is that correct? So based on this, you can look at what is the price. 3 divided by 0.03425. And the answer you all are giving me is 93.1258. So, any questions here before we move on? So this sum is there for you to understand how your risk premiums adjust. Risk premiums adjust, and your required rate of return changes with different indenture provisions. Try this sum. Try the first part, and then I'll give the answers to the next parts, but try the first part. And for the other parts, you don't need to give the final answer, but put the basics down in terms of what are the things that you need to enter into the equation. But for the first part, calculate the final answer. No, Johnny, I think you are not taking the frequency into consideration for one of the variables, something. Just double check again. Remember, this debenture was issued in 2013. And now, today, it is 2018, June. What are the questions that you all are coming across? What are the problems? Confusions? If there are no confusions, I should be getting answers by now.
Madam, sorry, that equation that what we should use is that I have a little bit of confusion that is it the same equation that we used previously or something?
No. Always this is the bond equation. All this says is the present value of coupons is this. No, Jarno. Yes, I think you're getting N wrong here. Always you can use this equation. So in terms of the equation, like I said before, you can either use this equation or you can use basic fundamentals that look at what are your cash flows. And if it's a very small number of cash flows, you can do it by fundamentals, by discounting each of these cash flows, right, for the number of periods and coming up with what is the price. So that's something you can do. But when you have like very high enough frequency of cash flows, this is not possible. So then that's why we use the equation. Equation, always remember, C is for the period, R is for the period, N is the number of periods. And for those of you who want to use annuity factor, you're welcome to use the annuity factor as long as you show me that you understand how to use the equation. Eranga, no, don't share it to everyone, but the answer is not correct. So annuity factor, if you have the annuity factor tables, you're welcome to use it. That's not a problem. But I will not provide it in my equation sheet. So if you separately want to bring in the annuity factor sheet and use it, and that's allowed, that's okay. But you have to fill in the equation so that I understand that you know, I mean, you understand the fundamentals, right? That's the only important thing. And even if you have a BA2 plus calculator or CFA calculator, again, to be fair to everybody, this equation needs to be filled out and the steps done. You can definitely double check through your CFA calculators whether your answers are correct or not. So you have this debenture that started out in 2030, right? The difference in this sum is we're looking at the price of the debenture in 2018. When this debenture started out, or it's 5 different debentures, round of issued, they raised money by issuing 5 different debentures, 5-year, 6-year, 8, 9, 10-year debentures, right? So do you see, if you remember the naming convention of debentures we did last week? I think, yeah, last week. Naming convention of debentures in the previous file, right? This gives you the maturity date of the debenture, and this gives you the coupon. So looking at this 2013 debenture, 30th of September 2013, the debenture was issued, and it is going to mature 30th of September 2018. This will mature 2019, 21, 22, 23, which is how we came up with the fact that this is a 5-year debenture, 2013 to 2018, 6-year debenture, 8-year debenture, 9-year debenture, and a 10-year debenture. Right? Now, the thing is, we are not, today is 30th of June 2018. Today is not 30th of September 2030. At the time this debenture was issued, the 5-year debenture was actually at a coupon of 14.15, versus the 10-year debenture was actually at a coupon of 14.45. Without, I mean, this is apart from the sum, right? Don't think of the sum for a moment. These debentures were originally, when it was issued, these are actual debentures that were issued in 2013, they were issued at par. What does that mean? They were issued at par. When they were issued at par. What does that mean? Sorry?
Not discounted or a premium debentures.
Yeah. So they were issued at 100, right? Or at face value. So at the time of the issue, the price of the debenture, 2013, the price of each of these debentures, this is not information that I've given here, but just a different set of figures. The price of these debentures were 100 at the time it was issued, right? What does that imply to you about the required rate of return? What does that imply to you about the required?
And the required rate of return are the same?
Yes. Exactly. Because your price is equal to face value, we know then coupon rate, your required rate of return is equal to your coupon rate. So in 2013, when people invested in this bond, right, their required rate of return was 14.15. 14.35. That's not relevant to this sum, okay? I'm just giving some additional information. And 14.45. So people, whoever invested in the 10-year portion of the debenture, were happy to get a 14.45% return to invest in the 10-year debenture. Because it's an Avaloka debenture keeping riskiness the same, this kind of gives you the premium, right? Over the 5-year debenture, only a 30 basis premium for the 10-year debenture at that time in 2013. So people were happy. Whoever decided to invest for the 10-year debenture was happy to invest and get a 14.45% rate of return. But all of this is in the past. Now today, the assumption is today is 2018. This is today. Today is 2018. Now, when I look at my debenture today, let's look at the first debenture. How much more time to go for it to mature? How much more time for it to mature?
One more quarter.
One more quarter, yes. Because it is maturing on 30th of September 2018, and today is 30th of June 2018. One more quarter to mature. So what is my cash flow when I look at today? When I look at today, what are the cash flows? Today is 30th of June 2018. This is 0. In one more quarter, this debenture is going to mature. And what is the cash flow I'm going to get? I'm going to get my coupon and I'm going to get my face value. So this debenture, technically, I don't even need the equation. I can straight away look at what is my coupon, what is my face value, and discount it over one quarter, and I can get the answer. As I go along, I can't do it. Correct, Jagan? That's right. Now it's right. So N is 1 for the first debenture. How much is N for the second debenture? No, for the second debenture?
5.
5. Yes. How much is N for the third debenture?
30.
Correct. Next one.
17 and 21.
So now you see what N is. So the difference is you're now looking at a different point in time. This is not from the time of issue, right? Obviously, as time goes by, the number of periods that are left that you get future cash flows from come down. That's what the sum shows you. When it was originally issued, the Navaloka debenture, the first debenture is a 5-year debenture. 5-year debenture implied to you 20 cash flows. But you're not going to get 20 cash flows anymore. You're 30th of June 2018. That's the day today. Today, you're only going to get one more cash flow. N is 1. Now, using this, calculate the price for 1 and 2, right? And I'll give you the prices for the rest. Assuming 2018, required rate of return is 10%. Okay, John, looks okay. Ravi, you're missing something. It's too low stake. Are you taking the face value into consideration?
Yeah, madam, I think
I think then maybe you're this minus n, are you putting it correctly? Make sure your brackets are okay because somewhere it's going wrong. 1 plus r to the power, again brackets, minus n.
yes, I have missed the minus then.
Okay, very good. So for the first debenture, for the very first debenture, this one. What is n? N is 1. N is 1. What is C? C is 14.15% into 100, right? That's the coupon for the year. But this coupon is paid quarterly. So I have to divide it by 4. So what is your quarterly coupon? 14.15 divided by 4. 3.625. NCR. R is 10% divided by 4. 2.5%. So now I can put this, right, to my numbers. So that's 3.625 divided by R 0.025 into 1 minus 1 plus R to the power minus 1, same as 1. 100 into 1.025 to the power 1. So when you solve this, I saw you get 101.01.
Madam, the coupon
Mhm.
14.15 divided by 4, it's 3.5375.
Is there? Okay. Yes, my mistake. Okay. So same way, you can do the same thing for bond number 2, bond number 3. Bond number 2 is easy because the coupon rate is the same. The only thing that changes is N. N is now not 1, N is 5. After that, we can calculate the price, and I think you're getting 104.82. Similarly, you can calculate the prices for all of these. Obviously, the coupon would change and you can calculate the price. So let's look at that. Okay. So you have the now local debenture. Coupon rate is 14.15, 14.15, 14.35, 14.4, and 14.45. Right. This debenture matures on 30th of September 2018, 30th of September 2019, 21, 22, and so on. So from that, I can calculate in this is on 2018. So N is 1 for the first one, 5 for the next one. Then you also said 13, 17, and 21, right? Then that's N. Then what I need is, what is the coupon? So the coupon is 14.15 into 100 divided by 4. And the coupon for each of these will change, right? That's a coupon. So what else do I need? I have the coupon, I have N, I need my required rate of return. Right. Required rate of return is in 2018, 10%. So my required rate of return is 10%. Only thing is required rate of return for the period. This is for the period. Is this divided by 4. So that's my required rate of return. So using this, I can now calculate my equation. I mean, I can do this a different way, but I will use my present value of coupons and present value of face value to find out what is my price. So what is the present value of my coupons? My present value of my coupons is coupon divided by R into 1 minus 1 plus R to the power minus N and face value divided by 1 plus R to the power N. And what is the price? Price is the addition of these two. So you got 101.12, right? And this is the price. So these are the answers that you all probably got. Okay. Now, one thing do you see? Remember, I told you in 2013, when this bond was issued, okay, what was your required rate of return? Required rate of return was equal to the coupon rate because this bond was issued at what? This bond was issued at par, right? Because the bond was issued at par, the required rate of return was equal to the coupon rate. Because the price was equal to the face value. Right. Because of this, we know that the price was 100. From 100, do you see my prices have increased? Why have my prices increased? That's the first question. In 2013, the price was 100. From 100 in 2018, my price is now 101, 104. Why is that?
Time risk. Time.
No, right? That's not the reason.
No, your required rate of return has come down.
Yes. Your required rate of return has come down. Your required rate of return is 14.15 in 2013, and today it is 10%. It has come down. Okay. So if I look at the differential, it has come down by 14.15% to 14.45%, right? That's the differential that it has come down by. So one of the things that you do see here is, or you should see here is, when interest rates come down, bond prices go up. That's the first thing. It was originally 100. Today it is 101. Why has it gone from 100 to 101? Because interest rates have come down. But do you also see, as increases, that means, if I draw this in another way, this is actually any number of years. Okay. From a quarter of a year to go to 5 years and a quarter to go, right? As the number of years increase, years remaining to maturity, right? Years remaining to maturity increases, what do you see about the prices? What do you see about the prices?
Increase.
Yeah. Do you see that when there is quarter of a year to go, from 100 rupees, price has increased to 101 rupees, right? It has increased by 1%. But when there is 5 years to go, from 100 rupees, price has increased to 118. It has increased by 18%. It has increased by 18%. When interest rates came down, prices have increased, but long-term bonds, prices have increased more than for short-term bonds. In long-term bonds, prices have increased more than it has for short-term bonds. This is why we generally say, when interest rates come down, bond prices go up. But long-term bond prices are more sensitive to interest rate changes than short-term bond prices. Therefore, long-term bond prices increase more than short-term bond prices. So that's what we're trying to show through this sum. Long-term bonds are more sensitive to interest rate changes than short-term bonds. Now here, why do we say interest rate changes and we're looking at required rate of return? This required rate of return is made up of the interest rate. Remember, required rate of return is risk-free rate plus risk premium. So assuming risk premium is the same, the difference in this 14% to 10% is really the risk-free rate coming down. Okay. So when we say interest rates have come down, that is because required rate of return has come down implies the interest rates have come down. Just to make this sum I keep the interest rate drop the same, right? Interest rate drop across the board is the same. So my required rate of return, I have changed somewhat. Why I have done that is, here when the bond was issued, you saw that for the 5-year bond, I wanted a return of 14.15. For the 10-year bond, I wanted a return of 14.45. There was a slight term premium between the 10-year and the 5-year. Assuming the same term premium stands, if my required rate of return for the 5-year is 10%, my required rate of return for the 10-year is 10.3%. So I just made a small change here, right? I mean, you see, it didn't make a huge change in our answers. From 118, this dropped to 160. Because this from 10% now became 10.3%. Okay. Now, let's see what happens. Let's see what happens when interest rates don't change. What do you think will happen when interest rates don't change? You start off with a bond that is worth 100 rupees. Start off with a bond that is worth 100 rupees, right? In 2013, the bond was worth 100 rupees. That was when my required rate of return was 14%, 14.15 to 14.45 range. What if today also my required rate of return in 2018 is also still 14.15 to 14.45 range? What do you expect the price to be?
100.
100, yes. It is 100 because if my required rate of return in 2018 also is 14.15%, it is still equal to the coupon rate. That means this price is at par. So if the rates don't change, interest rates don't change, my required rate of return is still the same as what it was in 2013, and my price is still 100. Okay, that's the first thing. What if my interest rates went up instead of coming down? What if interest rates went up instead of coming down? What do you think will happen? So today in 2018, interest rates have gone up. In my original example, it came down, but let's assume it has gone up. Then what do you think will happen to the prices? What is the pattern you should see?
So the required rate of return goes up and the prices will come down.
Yes. Above 100, below 100?
Below 100?
It should come down below 100. It should be at a discount, correct? Because your required rate of return is now greater than the coupon rate. So when interest rates go up, your required rate of return will be greater than the coupon rate and your prices will now be at a discount. But which prices will be at a greater discount?
Longer term.
Longer tenor bonds will be at a greater discount, right? So let's increase my interest rates by 5%. What do you see? When interest rates increase by 5%, do you see that this bond has come down? The first bond with 1 quarter to go from 100 rupees in 2013, it is now only worth 98 rupees. But this last bond, this 10-year bond, which is now a 5-year bond, is only worth 83 rupees. So when interest rates came down from 100 rupees, you see, my prices have come down, and the prices have come down the hardest or highest in my longer tenor bonds. This is what we call interest rate risk. Interest rate risk. When interest rates go up, my bond prices come down. When interest rates go up, my bond prices come down. And longer tenor bonds are more sensitive to interest rate changes than shorter tenor bonds. So when interest rates go up by the same amount, my longer tenor bonds will come down in price more than my shorter tenor bonds. This is interest rate risk. Okay. If interest rates come down, same thing. My long tenor bonds will go up more than my short tenor bonds. So when I want to take a bet on interest rates, when I want to trade bonds, for example, bond traders, they take bets that interest rates will fall, right? They speculate or they estimate or analyze that interest rates will fall. When interest rates they think are going to fall, they will load up as much bonds as possible to their portfolio because they want to make gains. And when they want to make gains, what are the best bonds to have? Longer tenor bonds, because longer tenor bonds will give you more gains than short tenor bonds. But what is the risk The risk is that in case you are wrong and interest rates go up, those long tenor bonds will give you massive losses versus short tenor bonds. That's the risk. Any questions? Okay. So we show this through this graph, right? If you remember last time, we drew this graph and we said, when you draw a graph against, oops, prices and interest rates or yields, right? Yields, that's interest rates. When interest rates are low, bond prices are high. And when interest rates are high, bond prices are low. And this is not a straight line, it is a curve. Yeah, seems I can't draw anything today. Curve. You have the price and you have the yield or interest rate, and you have a curve, right? Now, in this curve, you can see when interest rates go up, prices come down, right? When interest rates go up, prices come down. Price comes down. Similarly, when interest rates come down, price goes up. But the same graph, the difference is if I draw this graph, now this is a graph for a certain bond, right? If I draw the same graph for a short-term bond, like a 1-year bond or a 2-year bond, the same graph, the intensity would be less. The curvature would be less. Versus if I draw the same graph, still the same, my graph doesn't look like a curve, but it is still the same shape, right? This green line is also still the same shape. Only difference is it's a less curved. Okay. If I draw it again for a long-term bond, it is more curved. The curve is intensified, right? So what am I trying to show here? Let's say from this point, unfortunately, I could draw better yesterday than I can today. Let's assume interest rates go down by 1%, right? When interest rates go down by 1%, the short-term bond goes up. The medium-term bond price goes up. The long-term bond price goes up. Do you see the long-term bond, because the curvature is higher, it is more sensitive to interest rates, the price increase is higher than the short-term bond's price increase, right? That is what we essentially why there is interest rate risk and higher sensitivity in long-term bonds. So that's what it shows here as well. And here you can see again, same thing. When interest rates go from 5.5%, right? From 5.5%, when they come down to somewhere like, let's say, 3% or 2%, what do you see when it comes down to 3%? Short-term bond price goes up by this much. But long-term bond price goes up by this much. Okay. So understand that when you want to trade in bonds, and we want to trade in bonds, we want to buy low, sell high, right? How do we buy low, sell high? We buy at high interest rate environments and we sell when interest rates come down. Like, for example, last year was a very good example. Obviously, there were other risk factors involved in the bonds because we had the risk of default that was suddenly involved in the treasury bonds as well. But if you had to take a call on how it was going to go and all of that. Once we remove that risk of default still, right? You're looking at the fact that from like near 30% interest rates came down, and today we are at nearly 12%, or 11, 12%. From that 30 odd to 12 odd, look at the amount of, look at how much interest rates have come down, right? Interest rates have come down to nearly 18% over the year. And when that 18% interest rate drop happens, if you are a trader who wants to take a bet on the fact that government securities prices are going to come down, sorry, not prices, rates are going to come down. And therefore, if I buy today meaning 1 year ago, maybe in another year and a half, I can make massive profits. Ideally, what type of bonds should you buy?
Long-term bond.
Long-term bonds. You should be buying longer the tenor, better for you, because the higher the profit you will make. So 10-year bonds would be better than 5-year bonds or 2-year bonds, because you're making bigger profits on those. However, if your assumption goes wrong, and Sri Lanka suddenly announced mid of last year, suddenly said, there is a DDO happening, everybody's going to go through a haircut, blah, blah, blah. If that came and then suddenly bond interest rates went up even more from like 30% to 50%, then your long-term call went wrong and you are going to make massive losses. So last year, 1.5 years to 2 years back, we saw this, right? For example, 2020, you had modern monetary policy theory, right? So 2020, our interest rates were very low. 2021, they were just starting towards the end of 2021, just starting to go up. So from like 5-6% rates, it went up to like 7% odd. 2022, early 2022, very early 2022, maybe around January, February, March, went to around 11%, right? And then 22 April, we defaulted on the sovereign bond, and our exchange rates crashed up to 380 odd. Bond rates also went up to maybe like 15-16%, right? Suddenly, this looks attractive. It looks attractive, right? Because if you look at our historical averages, maybe bonds have been in the range of 11 to 14%. Rates go to like 15-16%, it looks better than 11%. Okay. So there were people who were buying bonds at this point, because these are good rates when you look at the history to buy it. Okay. Because it looks like our obviously there was a riskiness involved. We had just defaulted on a sovereign bond, and our exchange rates have suddenly elevated, right? And to reflect that, bond rates have also gone up. Then Argale came. Sri Lanka went into crisis mode. Bond prices went up further, 20%, and then even further, 30%, right? People who got here bought bonds here thinking this was attractive rates, which was a reasonable assumption at the time that they were making it, suddenly got caught out, right? Because they purchased it thinking that rates will now, after some time, come down and they will make gains. But rates actually went up. That's interest rate risk. For those who purchased long tenor bonds, interest rate risk would have been higher than those that purchased short tenor bonds. So you make certain assumptions and you do a trade, right? You make certain assumptions and you will buy Commercial Bank or John Keel's or Expo or whatever, right? But those assumptions may be proved right or wrong in the long run. So same way, people made certain assumptions thinking 30% was an attractive rate and purchased bonds. They could have gone wrong. Fortunately for whoever did that, they were right, or they were proved right, right? And interest rates came down to nearly 12% levels. But they could have gone wrong. DDO could have been implemented to everybody. And therefore, interest rates could have gone up even further. Could have happened, which would have decreased your value even more. So for somebody who purchased bonds here, maybe their value would have decreased like by maybe even 40, 50%. And for somebody who purchased bonds here, they would have made gains, maybe even like 85, 90%, depending on the type of bond that they purchased. I mean, why do you think the bond scam happened on the longest tenor bond that there was, right? So last class, one of the Saturday group, one of your colleagues was asking about the bond scam. And the bond scam happened on the... that was you, is it? Sorry. So it was the Sunday group. I remember it as a Saturday. So the bond scam happened on the 2045 bond. That was the longest tenor bond at the time. It was a 30-year bond. So why did it happen on the 30-year bond? That's what's more relevant for us. Because really speaking, the bond scam is a problem about insider trading. Okay? It's a problem about the fact that whether more information was known by one party than other market participants. But because of that information, how did that party make gains, right? If that information was known, how did that party make gains? That's what's important to us. So, for example, at that time, there was I can't remember the details offhand exactly, but there was 10 billion that was being offered, something like that, right? Some 10 billion that was being offered on auction on the 30-year bond. So after a long time, the 30-year bond was being auctioned and 10 billion was offered on the 30-year bond. And you understand in an auction, though at that time, interest rates that were prevailing in the market would have been somewhere around 9 to 11%, something like this, right? So it was auction. And then what happened was central bank actually accepted more than what they announced that they would accept. They accepted 3 times more. They accepted 30 billion, which is a very high amount, right? Usually you accept more, but you accept 10% higher, 20% higher. Here they accepted 3 times more than what was originally said. And in an auction, you know that when market participants bid, they bid starting from like different rates. Different market participants will bid. If you remember our very first treasury bill auction notes, right? And some people would have bid at 9%, some people would have bid at 11%, and some people would have bid at 13%, 14%, right? Now, it could be that you just got lucky, or it could be that you knew something more than others did, okay? Because it was a related party who got hit on the very high amounts. That is why it is alleged that you knew more than other market participants, some who were bidding at 9% and getting bonds at 9%, when some people were bidding and they were getting bonds at 14%. So what happens? They get the bond at 14%, they are successful in their bid because without accepting 10 billion, which might have been the cutoff, might have been here, for example, right? I'm just putting numbers, just putting random numbers. If central bank accepted 10 billion, the cutoff might have been here, but because you accepted 30 billion, your cutoff was even higher. You accepted more bonds. And people who got these bonds at these very high levels, suddenly the market has to adjust, right? Because the market was somewhere around 9 to 11%, and the market would have adjusted up, but not to these 14% levels, would have adjusted up to like 12, 13%. Now on a 30-year bond, somebody who got it today is immediately selling it in the market at 12%. For example, a 2% gain immediately, right? This is not waiting from 2013 to 2018. This is that day. That day, you're selling it at this huge gain, huge discount in interest rates, and making massive gains because it's a 30-year bond. And 30-year bond, the sensitivity to interest rate changes is very high, right? When interest rates come down by 2%, the amount of money that you will make on that reduction is very high. So although the market adjusts, some people got it at much better levels. And most of these people who got it at much better levels were related parties, which was where the allegation comes that they knew more than the market knew, right? That is what needs to be proven, whether insider trading was involved. But for us, what's relevant is how that profit came about, or how that profit was made, or why that scam, if it happened on the third year, because that's where the highest profit could be made. Any questions? Okay. So it's 10. Let's take a 15-minute break, 10:15. We'll be back and start on this question, please. And start posting the answers. 10:15, we'll be back. Okay, journey looks okay. Looks good. Hey, Banker. And you're not getting the same answer as Janani. Can you please just show me the inputs?
Madam, I think I used the N as years, not month.
Okay, so you have to use it a number of months, the
Yeah.
frequency. We have a 10-year debenture. 10 years in 2018. Coupon is 15%. Investors' required rate of return is 12%. Both are monthly coupons and compounded monthly. Okay. And at what price will the company have issued the debenture? So in 2018, what is the price of the debenture? That's the first question that is being asked. So what are your inputs? You need to know what is C, what is R, what is N. C, it's a 15%. Oh, sorry. Before we do this question, is this a premium bond, par bond, or a discount bond? Without doing any calculations. This is a
The
premium bond.
premium one.
Premium bond. Why? 15% monthly coupon, but you only want a return of 12%. So how do you make a return of 12% from somebody that's giving you 15? You have to buy it at a premium. Right? So that should be your answer, should be a premium bond. That's the first check. 15%. 15%. So coupon is 15% into 100 divided by 12. How much is that coupon? 1.625. 25, sorry.
1.25.
1.25. R. R is investors' required rate of return. It is 12%. Compounded monthly. So per month, that's the period, per month, it's a 1% return. 1%. R is absolute number. Sorry, C is absolute number. R is a decimal. N, it's a 10-year bond. 12 cash flows each year. So 120. Now you can put this to the equation. And I think you're supposed to be getting 117.43. Is that correct? If there's something wrong, please let me know. Okay. So I only have one person's answer. I have no verification method. So you all can figure out whether it's correct or wrong when you're actually doing it for the exam. So calculate the maximum price an investor should pay to purchase this debenture after 6 years. After 6 years. So now here, 6 years have gone and investors' required rate of return remains constant. That's an important thing. Here we are assuming that the required rate of return does not change. My required rate of return is 12% and this does not change. But 6 years have passed. So how much is that? It is not. So good question. It is not. Johan, yes. N is correct. So earlier, I think the question stems from the fact that earlier we saw that when the coupon rate, in my first question, right here, remember we said if there was no change in interest rates in 2018, your prices were 100, sorry, 2013. In 2013, at the time of issue, all these prices were 100. And we saw that when there was no change in interest rates, 0% change in interest rates, in 2018 also, your prices remained 100, right? But that is a special case. That is because your coupon rate and required rate of return were the same. But here, your required rate of return remains constant at 12%. But coupon rate and required rate of return are not the same. Coupon rate in this case is higher than your required rate of return. So actually there will be a difference. Just give me 1 second, please. Sorry about that. Ranga, no. Again, I think there are certain problems in the calculation. Can you please input your basic figures? What is C, what is R, what is N? Just input it to me, please, so that I can see what your inputs are. So in this question now, what has happened is time has passed. Interest rates have not changed. Your inputs are correct. So it is really a equation problem, a calculator problem, right? I think your brackets, there's something wrong in the way that you're using your brackets because it's a calculator problem. Your inputs are correct.
Yeah, I'll click on that one.
So C, you understand, does not change, right? C does not change. It remains at 1.25 because it's something that the company pays you. You have no control over it, right? So it's 15% monthly coupon divided by 12 is 1.25. R also here it says required rate of return remains constant. Because of this, R doesn't change. It is 1%. Only N changes. Now the big question is N 6 years into 12? Or is N 4 years into 12? 6 years have passed. 6 years later, we're looking at what is the price of this debenture. So what is N? Is it 6 into 12 or 4 into 12? What is 4? 4 is 10 minus 6, right? It was originally a 10-year bond. So is N 6 into 12 or 4 into 12? And why?
Four, madam. It's a remaining period.
It's the remaining period. This is the present value of future cash flows. So the remaining period is 4. So it is 48 in this 48. Okay. So you can then again put the number correct there. Around correct. 1.25 divided by 0.01. But now it's 48 minutes. And you get 109.48. So here, unlike this scenario, where the prices remain constant when the required rate of return remain constant, prices remain constant at 100. You can see here, prices have changed. And it has actually come down from 117. No change in required rate of return, but prices come down. Okay? This is typical of a premium bond. So if we, for example, let me draw this. Now what I'm drawing is the price versus time remaining to maturity, right? Time remaining to maturity. So in my bond, with 10 years more to go, my bond is worth 117. With 4 more years to go, my bond is worth like 109 rupees. At maturity, how much do you think this bond is worth? At maturity, how much do you think this bond is worth? With 0 years to go. 100, correct. Bond is worth 100, right? Why is it worth 100? Because if you look at future cash flows, there's nothing else, no further future cash flows to get. So this bond is worth 100. So always we know at maturity, the bond will be worth 100. Whether you buy it at a discount or whether you buy it at par or premium, the bond will always fall towards, or sorry, be worth 100 at maturity. So keeping that in mind, what you will see is in a premium bond, your bond value will always fall towards 100 with time, as long as interest rates remain constant. Your bond prices will keep on moving towards par. Bond prices will keep on moving towards par, and it is not a straight line. It is actually a slight curve, right? So it is not a straight line. This is not me not being able to draw a straight line. It is not a straight line. It's slight curve, right? It will move towards 100. So that's why with 4 more years to go, you saw that the rate is now, or the price is now 109. The same phenomena, if it's applicable to a par bond price will not change with time. It will remain at 100. This is a straight line, okay? This is not a curve. It will remain at 100. For a par bond, price will not change with time. As long as your interest rates remain constant. This graph is only true if your interest rates or your required rate of return does not change. If your required rate of return or interest rates do change, then this graph will not be true. Okay. So on constant interest rate environments, you see that premium bonds will move towards par. Therefore, the prices will keep on, the value of the bond will keep on coming down with time. Par bonds remain at par. Par bonds remain at par. And what do you think happens in discount bonds? Discount bonds, you start at like 90, 10 years to go. Let's say you start at around 80. What do you think happens in a discount bond? This will also move towards par, correct? Okay. In a slight curve, it will move towards par. Yeah, it will move towards par. That's a discount bond. So a discount bond with time, if interest rates remain constant, the value of the discount bond will keep on going up. The amortization of the discount bond will keep on moving up. Versus in a premium bond, it will keep on moving down with time. So this was actually the slide that we jumped earlier. This is what is shown in the slide. Here, the example that they have taken is 6 more years to go. You have a par bond. You have par bond, premium bond, and a discount bond. So you see how the bond price moves with maturity, time to maturity, as long as interest rates remain constant. Interest rates remain constant. You should also understand that original graph that we have. Now, looking back at this graph again, price versus interest rates. Yeah. Do you understand that when price is 100, okay, that means when your price is 100, that means it's equal to face value, right? Assuming that your face value is 100. What is the unique feature you will see about the interest rate of this bond? When your price is equal to 100 of face value, what is the unique feature you will see about interest rates of this bond? Equal to interest rate is the required rate. So your yield is it's not equal to required rate. Your required coupon rate. That's correct, right? So your yield will be equal to your coupon rate, right? Correct. So now, do you see when interest rates go up? When interest rates go up, bond prices come down. And do you realize that below or above this, essentially any interest rate above this, right? Your interest rate or your yield, I'm using interest rate, but yield is better word to use. Yield is greater than your coupon rate. Yield is greater than your coupon rate. Because this is the yield that will give you your coupon rate. Then at any point in time, any other interest rate is greater than your coupon rate. And at that point, at any of these windows, your price is less than your face value. You have discount bonds in this region. Right? Anything below this line, it's a discount bond, which is what we see, yield greater than your coupon rate. Same way, anything above this line, or when interest rates come down, what do you see? My yield is actually below my coupon rate. I want to return below my coupon rate. And at this area, we also see that the price is greater than face value, which is correct, no? Right. This is the area where yield is less than my coupon rate. This is the area where I should be getting premium bonds. So when your price is equal to face value here, I get a par bond. Everywhere else, I will get discount bonds if my yield is greater than coupon rate, or I'll get premium bonds, or my bond will be selling at a premium when my yield is less than my coupon rate. This is for a single bond. It will be selling at par when my yield is equal to coupon rate. It will be selling at a discount when my yield is greater than the coupon rate, or at a premium when the required rate of return is less than the coupon rate. So that is what is shown in this graph. So that's the slide we jumped. We said we'll come back to that. Yeah. So we are now still in example 6. Example 6 is not over, right? There are 2 more questions on example 6 that we need to do. Now, first part of this example, what did we say? In 2018, when this was issued, what was the price this would have been issued at? So it was issued at 170. 6 years later, in 2024, now this is worth 109 if interest rates remain constant. But really, today, we know that interest rates have changed. Interest rates are lower, right, than 2018. So actually, how much is this bond worth? That's the third part. Try this.